Bitcoin's correlation to global liquidity has been one of the biggest themes of this bull market so far. And when you dig into that correlation in detail, it's clear why it's drawn so much attention. So, I set out to build a custom set of metrics to really put this relationship to the test. Not just the surface level stuff you see on Twitter, but something more rigorous and data driven. And I guarantee these results aren't something you've seen anywhere else before. So, let's dive in. Before we jump into the specifics, it's important to understand what we're actually measuring when we talk about liquidity. Global liquidity isn't just one simple number. It's a complex mix of different money supply metrics that capture how much capital is circulating in the economy at various levels. Getting this right is crucial because it directly impacts asset prices, especially ones like Bitcoin. So let's start by breaking down the most commonly referenced money supply metric out there. You'll have likely seen the label M2 floating around a lot, but most people couldn't even tell you what it means, or that there are multiple other types of M's out there. M2 is the main money supply metric people use today, and it includes physical cash, checking accounts, savings accounts, and small-time deposits. Basically, money that's relatively liquid and can be spent or moved into assets pretty easily. It gives us a decent picture of how much capital is sloshing around in the system, especially from consumers and smaller investors. It's not perfect, but it's the broadest reliable measure we've got. Really, we should be looking at M3, which includes institutional money market funds and much more, because that's a huge pool of capital that can move markets in a big way. But the Fed stopped publishing reliable M3 data back in 2006, right before the global financial crisis, so we all have to settle for M2. Still, it's clear there's a lot more capital sitting on the sidelines than what is published in the media. If we're getting technical, M0 is the actual cash in the system, and everything else is essentially credit or leverage. That's why they have to keep debasing the currency. And that's why we're in Bitcoin. It's the only true fixed supply asset in a world full of infinite money printing. And as long as the current system relies on constant debasement and infinite debt, Bitcoin's price in these currencies is structurally trending towards infinity too. It's almost a foregone conclusion unless the current system changes radically, and there's definitely no signs of that happening anytime soon. Once this concept clicks, people finally start to grasp Bitcoin's true market value. Anyway, enough of the financial philosophy. Let's get into the charts and look at how we can use these money printing trends to our advantage. The chart you're seeing here is my take on the standard M2 global liquidity chart, which you have probably seen circulating a lot over the past year. Basically, it shows that when you measure global liquidity with a 2 to 3 month lag, it lines up remarkably well with Bitcoin's price moves, both the ups and downs. We've covered this in a lot of previous videos, so I won't dwell on it here. But if you want a simple go-to chart for a broad understanding of where Bitcoin's price might head based on the macro liquidity environment, this is it. The standard M2 liquidity indicator is useful, but its overall direction is just up and to the right. And that's fine for Bitcoin's long-term trend, but it hides the more subtle shifts in liquidity trends. That's why I prefer looking at the global liquidity year-on-year delta, essentially the percentage change in M2 money supply over the past year. This gives you a broader macro view of whether liquidity is expanding or contracting. It makes spotting major shifts in global liquidity easier, shifts that often lead to significant moves in Bitcoin. Looking back at the last two cycles, you can see major booms in the year-on-year liquidity growth coincided with market cycle peaks. This is the chart most people refer to when they argue that Bitcoin's price is influenced more by global liquidity cycles than by halving events. Now, fast forward to this cycle, the bear market bottom happened when the year-on-year global liquidity was actually contracting. That's a pretty rare event historically. It was a loud signal that the Bitcoin market was likely forming a bottom at that time. Currently, liquidity is trending upward, and right now it's running at about an 8% year-on-year increase. To me, that's another indicator that we're not at the Bitcoin cycle peak yet. Cycle peaks tend to occur when liquidity growth goes into overdrive. When the chart's green colors get brighter and more intense, that's when you know things are ramping up. It looks like we could be building toward that point, but we're not there yet. If you look at the Bitcoin equivalent of the year-on-year percentage change, you see very similar patterns. These allow you to spot bull market tops and bear market bottoms with surprising precision. But the real value isn't in these charts alone, it's how you compare them against each other. I've created an indicator I call the Liquidity Correlation Index. It measures how closely Bitcoin and M2 liquidity growth have moved together over a recent period. It essentially measures how well their growth is moving in tandem. Most of the time, this indicator lights up grey, with lighter greys showing a very high correlation. That's exactly what you'd expect, because Bitcoin's value isn't just about adoption or supply and demand. It's also about how many currency units are circulating at any given time. Right now, Bitcoin's year-on-year growth is about 73% correlated with liquidity growth. But here's the interesting part. When the indicator flashes bright teal, it means Bitcoin and liquidity, year-on-year growth, aren't moving together at all. This can go both ways too. Either Bitcoin's growth is outpacing liquidity growth, or liquidity growth is outpacing Bitcoin. It doesn't tell you exactly what's going on, but it gives you a clear signal to pay attention and investigate why this disconnection is happening. Let's look back at recent history to see what these dislocations meant for Bitcoin's future price. Back in March 2019, Bitcoin's price dropped and stagnated while global liquidity was surging, which then led to some explosive price action shortly after. Then, in March 2020, we saw the next dip, driven by Bitcoin's crash during the COVID market collapse, which was followed by a sharp rebound straight afterwards. Shortly after that, the correlation dipped again, as global liquidity was being pumped heavily into the system, but Bitcoin remained stagnant once more. That was followed by the final parabolic rally. The next dip in correlation is an outlier and is actually quite interesting. This time, Bitcoin's price pumped far harder than liquidity was growing. If you were around then, you'll remember this final pump was often called a dead cat bounce by many analysts. It was short-lived and, for many, signaled the last point of weakness before the bear market truly set in. This shows the signal isn't just about spotting opportunities where Bitcoin's price can grow. It also acts as an early warning when liquidity is drying up and Bitcoin's price isn't following suit. The last two major dips in correlation this cycle happened just before major rallies, where Bitcoin caught up with global liquidity again. So, this indicator is very useful, not necessarily to predict exactly what will happen next, but to tell you when there's a dislocation between two normally tightly correlated factors. It's a signal you absolutely want on your radar if you're hunting asymmetric opportunities, both up and down. Now, the final metric I call the Liquidity Dislocation Index. It builds on a similar idea but with a twist. Essentially, it shows how much Bitcoin's price growth is outperforming or underperforming M2 liquidity growth over a longer time frame, typically about a year, adjusted for normal market fluctuations. It tries to estimate when Bitcoin is priced too high or too low relative to the global liquidity trend. I use it as a way to spot bigger, longer-term shifts or bubbles, and to see how far apart these two are compared to their usual behavior. Green on this chart means Bitcoin's year-over-year performance is underperforming relative to global liquidity growth. In other words, Bitcoin is relatively undervalued compared to the liquidity expansion. We saw this play out perfectly during the COVID liquidity stimulus, when liquidity was pumping hard, but Bitcoin's price stayed steady for a while, and we saw what happened next. On the other hand, red means Bitcoin's year-over-year performance is outperforming compared to global money supply growth. This has shown up a few times as Bitcoin's explosive price growth has far outpaced liquidity for that particular stage of the cycle. Interestingly, we've been in this green zone for several months now, with global liquidity ripping higher year on year, while Bitcoin's relative performance remains subdued. This doesn't mean Bitcoin is about to skyrocket immediately, but historically, if global liquidity continues expanding at its current pace, Bitcoin tends to revert to the mean and catch up eventually. This indicator gives a macro-level view of the market. So, what Bitcoin does in the next month or two isn't as relevant, but over the next 6 months to a year, the liquidity tide that lifts all boats is likely to come into effect. We don't know exactly when it will happen, but history gives us strong confidence that it will happen eventually. So, to wrap things up, the key takeaway here is just how closely Bitcoin's price tracks global liquidity, specifically the M2 money supply, with about a 2 to 3 month lag. This relationship really highlights why liquidity cycles are so important to understanding Bitcoin's market moves. When liquidity expands, Bitcoin tends to follow, and when liquidity contracts, you often see the price struggling or even bottoming out. Another important point is the role of the liquidity correlation index. This tool shines a light on when Bitcoin and liquidity growth start moving out of sync, which is a crucial signal. These moments of dislocation can either warn us that liquidity is drying up while Bitcoin is still holding, or that Bitcoin is pumping too hard without the backing of liquidity. Either way, it's a powerful indicator for spotting asymmetric opportunities, whether you're looking for entry points before a rally or warnings before a downturn. Finally, the liquidity dislocation index gives us a broader perspective by showing when Bitcoin's price is significantly overperforming or underperforming relative to liquidity over a longer time frame. It's a fantastic way to identify when Bitcoin might be undervalued or overvalued compared to the overall liquidity environment. Historically, when Bitcoin's relative performance lags while liquidity is surging, it tends to catch up eventually. So it's a key metric to watch for understanding where the market could be headed over the next 6 months to a year. All in all, these metrics give us a clearer, data-driven picture of Bitcoin's price action and where we currently stand in the cycle. Right now, global liquidity is expanding rapidly, and despite Bitcoin's recent surge, the price hasn't fully caught up to its long-term trend. This suggests we're still building momentum ahead of another major rally. Understanding the lag is your key to avoiding jumping the gun and positions you to capitalize when the tide finally turns in Bitcoin's favor. If you're serious about Bitcoin analysis, my full custom indicator suite is now live, built for investors looking to gain an edge through deep cycle signals and advanced on-chain insights. It's available now through the link in the description, where you'll also find my free newsletter. And if you found this valuable, hit the like button, subscribe to the channel, and turn on notifications so you never miss an update. And I'll see you all in the next one.